You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. Today, we are looking at the big stagecoach, Wells Fargo, covering the fourth quarter of 2025. It is January 14th, 2026. The asset cap is finally history. The chains are off, but looking at this report, it feels like they tripped coming out of the gate.
Yeah, it's messy. Headline numbers are okay, but not great. Earnings came in at $1.62 a share, down from $1.66 last quarter. Revenue was basically flat, just a hair under $21.3 billion. If you were expecting a victory lap because the Fed lifted the cap, this wasn't it.
And the market noticed, right?
Oh, yeah. They sold it off hard in the pre-market. It opened near 90.75 and just kind of ground lower all day. Closed at 89.25, down about 1.6%, which is interesting because the stock had been on a tear going into this. But today, investors took one look at the expense line and blinked.
Expense line? Let me guess. Severance again?
Again. $612 million in severance. It's like they're addicted to restructuring charges. But look, before we get too cynical, and just a quick reminder for everyone that this is definitely not financial advice, just two people reading a balance sheet, there is actually a fascinating anomaly here.
The net interest income.
Exactly. While pretty much every other bank is seeing NII compress, Wells Fargo posted $12.3 billion in net interest income. That is up 3% from the third quarter. That is a massive divergence from the sector.
So wait, they're making more money on lending, but earning less overall because they're firing people or setting money aside?
Both, but mostly the setting money aside part. Provision for credit losses jumped 53%, over $1 billion this quarter. That is a robust number.
53% jump? That feels like a warning light. Is that actual bad loans, or are they just padding the walls because they're growing again?
That is the multi-billion-dollar question. Management says it's growth math. New loans need new reserves. But when you see provisions spike that hard while the economy is supposedly soft landing, you have to wonder if they're seeing something in the commercial book that we aren't.
Okay. That sounds like the perfect place to start digging. All right, let's get into the details and see where that money is actually going.
Well, if you want to find the money, you have to look at the tug of war between the lending arm and the deal-making arm. Because while the interest income, the lending side, was doing the heavy lifting, the fee business just kind of evaporated.
Evaporated? That sounds dramatic.
Maybe a little, but the numbers don't lie. Non-interest income dropped 6% to $9 billion. Investment banking fees were the real drag, down 18%. So while the bank tellers were busy, the Wall Street bankers were apparently sitting on their hands.
Ouch. But wait, I saw wealth management was actually a bright spot.
It was. Wealth revenue was up 4% to $4.36 billion. It's the one place where higher markets directly pad the top line. But the part that actually caught my eye, and this goes to your point about where the money is going, is the auto business.
The car loans? I thought they pulled back from that years ago.
They did, but they're back. Auto balances jumped 19% year over year. They actually struck a deal to be the preferred lender for Volkswagen and Audi. So if you bought a Jetta this quarter, there's a decent chance you're sitting on Wells Fargo's balance sheet right now.
I'll have to check my glove box. That's actually a really tangible shift, though. It feels like they're finally trying to be a normal bank again.
Trying is the operative word, but being a normal bank is expensive. Even though they cut headcount by over 5,600 people this quarter, they're guiding for expenses to actually go up in 2026.
Wait, hold on. So they fire 5,000 people, reduce headcount, and the bill still goes up? How does that math work?
It's the pivot from cutting to building. They're targeting almost $56 billion in expenses next year because they have to pour money into tech and infrastructure to handle the growth they want. And that has a casualty.
Let me guess, the shareholders.
Bingo. They bought back $5 billion of stock in Q4, which is solid, but Charlie Scharf was very explicit. He basically told investors, don't get used to it. He wants to keep that capital to fund organic growth now that the Federal Reserve isn't holding a pillow over their face.
That is a vivid image. But it makes sense, right? Why buy back your own stock if you can actually use the money to compete?
Exactly. And that shift from defending the balance sheet to aggressively deploying it is what changes the whole thesis. Because underneath the headline noise, they just separated their trading income from the rest of the bank for the first time.
Oh, that sounds like a signal.
It's a massive signal. It means they aren't just lending money anymore. They're getting ready to trade it. And that is a completely different risk profile.
Okay, so let's pause there for a second. You're saying they separated trading income on the books for the first time. That sounds like, well, it sounds like they're putting a neon sign on it.
That is exactly what they're doing. They're effectively telling the street, look, we aren't just a mortgage factory anymore. They're guiding for about $2 billion in what they call markets NII for 2026. It's a way of isolating the volatile, high-octane trading revenue from the boring, steady banking interest.
Which is smart, right? It helps analysts model the business better. But isn't there a risk in highlighting the volatile stuff?
There is. But here's the thing that really changes the story for me. It's not just an accounting change. It's a physical change in the balance sheet. Charlie Scharf dropped this stat almost casually, but trading-related assets grew 50% year over year.
50%? That is massive.
It's huge, and it's the most direct evidence we have that the asset cap removal is real. For years, Wells Fargo had to throttle these businesses because trading is capital intensive. You need a big balance sheet to hold inventory, to facilitate flows for clients. They legally couldn't do it. Now, the handcuffs are off and they are sprinting. They are aggressively using that balance sheet to compete with the big boys, JP Morgan, Goldman, Citi.
So the sleeping giant is actually waking up.
He's waking up and he's hungry. But Susie, this connects back to the point about buybacks. Investors love buybacks because they're safe, predictable sugar highs. But trading consumes capital. Growing a loan book consumes capital. When Scharf says buybacks will be lower in 2026, he's saying, I have a better use for this dollar than giving it back to you. I can put it to work.
Which is technically what you want a CEO to do, right? You want them to have ideas that are better than just shrinking the share count. But it changes the vibe. It changes them from a value stock that pays you to wait into a growth story that needs to execute.
Precisely. And that execution risk is the new variable. When you're just cashing checks from mortgages, the risks are boring. When you increase your trading assets by 50%, you're introducing volatility. You're introducing market risk. And frankly, Wells hasn't had to flex that muscle in a long time. The muscle might be a little atrophied.
That's a great point. It's like someone who's been in rehab for 6 years suddenly entering a triathlon. But you know, there's another number in the report that makes me wonder if they're playing it safer than it looks. The CRE office portfolio.
Go on.
Well, everyone is terrified of office real estate, right? It's the boogeyman of the banking sector. But I saw they have a coverage ratio of 10.1% on their investment banking office loans. That feels incredibly high. Like they aren't just reserving for rain, they're building an ark.
It is high. 10% coverage is basically admitting you expect significant pain. But you're right, it's defensive. It suggests they have ring-fenced that risk. Mike Santomassimo, the CFO, even said the losses might be lumpy, which is finance speak for ugly but manageable. So you have this duality, extremely defensive on legacy risks like office space and extremely aggressive on new risks like trading.
That's the part that really changes how I see their whole strategy. They're trying to swap out bad risk for good risk. Like, let's clean up the office mess, pay the severance, take the hit, and bet the farm on becoming a trading powerhouse.
It's a pivot, A messy, expensive pivot, but for the first time in a decade, it looks like they're actually playing offense.
So let's step back for a second and think about what all this means going forward. If they're truly back in the game, where does that leave them heading into next quarter?
It leaves them with nowhere to hide. That is the reality of taking the asset cap off. You lose the biggest excuse in the playbook.
Right. No more, the Fed ate my homework.
Exactly. And looking at the outlook for 2026, the training wheels are definitely off. The thing that sticks with me is that expense guidance. They are telling us expenses will actually climb to almost $56 billion next year.
Which is kind of ironic, isn't it? We just spent 5 minutes talking about layoffs and $600 million in severance, and the bill's still going up?
It is the cost of reentry. You can't build a trading desk or upgrade your tech stack with cost cuts. You have to spend. But for an investor, that is a tough pill to swallow. You're getting fewer buybacks, higher expenses, and a promise that growth is coming.
It feels like a total regime change. For the last few years, the thesis was simple. Wait for the cap to lift, buy back stock, print money. Now the thesis is wait for them to out-execute Jamie Dimon.
Which is a much harder bet to make. So if I'm looking at the next quarter or two, I'm watching two things. One, does that provision for credit losses stabilize, or does it keep climbing past $1 billion? And two, can they actually generate that training revenue without blowing up the risk models?
The elusive clean quarter. That's what we're really waiting for. A quarter without a massive severance charge or a special accrual, just banking.
I wouldn't hold your breath. Big banks are messy by design. But at least now the mess is coming from trying to grow, not trying to survive.
That's a fair distinction. A clearer path, even if it's uphill.
It's honest work. Expensive, risky, honest work.
Well, honest work is all we can ask for. All right, let's close this out.
And before we completely sign off, just a quick peek behind the curtain. Earnings Unscripted is actually an experiment by a small team of enthusiastic humans exploring the absolute frontier of generative AI. Basically, they are asking the question, can technology actually enrich how we learn and consume complex data? To be transparent, this episode was created by a coordinated team of AI agents. We have a research analyst agent digging through the filings, a script writer, a QA specialist checking the facts, and then, well, there's us, the hosts. We're all working together to synthesize these massive reports and deliver high-quality, up-to-date information that honestly would be really hard to produce this quickly otherwise. The goal isn't just to read numbers, but to find the story inside them. We hope it felt valuable. If you have questions, comments, or you just want to see how the sausage is made, please reach out. You can email us at earningsunscripted@datamadness.ca or follow the project on X. We'd genuinely love to hear from you. Thanks for listening to The Experiment.
See you after the next call.